Do you want to invest in the stock market but don't have the time to do the research? Do you want to know the best way to go about it? Welcome to the Wisdom Inspired Talks podcast. I am Yomi Akinpelu, your wisdom coach, speaker, teacher, and author of Blow the Cap Off Your Capability. Today, I'll be speaking about 5 timeless tips from the father of index funds, Jack Bogle. So, let's dive right in. We all know Warren Buffett, Charlie Munger of Berkshire Hathaway, but not many know Jack Bogle, the grandfather of passive investing, index funds, and the founder of the Vanguard Investment House, which is the biggest provider of mutual funds. It has been said that Jack Bogle has helped more investors create wealth than anyone else on earth. He did this by creating low-cost passive investment vehicles that anyone can buy. He also is the author of the Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market return. There are few investment managers, of course, who are very good, though in the short run, it's difficult to determine whether a great record is due to luck or talent. Most advisors, however, are far better at generating high fees than they are at generating high returns. In truth, their core competence seems to be salesmanship. So rather than listen to their siren songs, investors large and small should read Jack Bogle's Little Book of Common Sense Investing. So, tip number 1. Invest you must. The biggest risk is not investing at all. If you are out on the sidelines waiting for the right time to get into the market, you will miss all the highs to make a profit, and you'll miss all the lows to pick up a bargain. No matter what the market does, you must invest. Cash is a poor investment because it is eroded by inflation, and cash in the bank does not work as hard for you, so you must invest. Tip number 2. Time is your friend. Start investing passively as soon as possible. The earlier, the better. When you are younger, invest more in stocks and shares, and as you grow older, start investing in bonds. Once you hit your 50s, you can start moving some of your shares into bonds. 60 to 40 or 40 to 60 ratio. The younger you start, the longer the miracle of compound interest has to work for you. Tip number 3. Impulse is your foe. When it comes to investing, your emotions can ruin you. So keep your emotions out of investing. In good times and bad times alike, remember, these too shall pass. That is why passive investing is the best form of investing. You just show up and invest regularly. Come sun, come rain, no speculation, just invest regularly in a good, well-diversified index fund. The reason passive investing works so well is that the strategy is impervious to your emotions. In other words, it's not affected by your vacillating feelings of fear or greed. You just show up every month or week and keep investing, and it works. Stick to the passive investing regularly. This is the dollar or pound cost averaging approach. This just means that there will be times when you will buy low and other times when you will buy high. At the end of the day, you are buying an average cost. Jack says, don't do something, just stand there, especially when the market is chaotic. Impulse is your foe, so invest consistently and invest passively. Tip number 4. Simplicity works best. Basic investing is simple. There are too many fortune tellers speculating, predicting, timing the market, and trying to pick winning stocks or the next hot stocks. Now, here is the thing. Research shows that passive investing outperforms the speculative activities of many active funds managers more than 95% of the time. And passive index funds are cheaper too. Jack says, don't try to find the needle in the haystack, just buy the whole haystack. By the way, if you're new to investing, an index fund is a fund that tracks an index and is like a big shopping trolley of all the items in that index. E.g., the S&P 500 consists of the stock of the top 500 companies in the USA. The FTSE 100 consists of the top 100 companies in the UK. So if you invested in one of these, you would be buying shares in all of those companies. Also note that fund managers charge higher fees than an index fund, but usually underperform. Index funds are much cheaper and more diversified. So just by buying an index fund or a single ETF, that is exchange traded funds, you have a highly diversified portfolio of sectors and companies and regions. You get exposure to all the stock in the entire market or that index fund. One stock gives you massive diversification. So all you need to do is balance your portfolio from time to time with bonds and shares. Make sure you choose to have your dividends or gains reinvested to benefit from the compounding interest. That is money making money on money for you. Tip number 5, stay the course. No matter what happens, stay the course. Passive investing is one of the easiest but also one of the hardest strategies to follow. It requires no brain power or high IQ. It has been proven to be extremely effective in generating great returns, but it's very hard to stay disciplined and keep investing regularly, especially when markets go down. The mistake some people make is jump in and buy when the stocks are going up and then jump out and sell when stocks prices plummet. This means that they buy high and sell low, and of course this leads to losses. It is irrational to buy goods at high prices and then sell them for a lower price. But this is what many people do when they keep on buying and selling their shares because the market fluctuates. But here is the thing. As long as you've got a well-diversified portfolio of index funds, whatever time you buy, whether at the top of the market or bottom of the market, just hold on and stay the course. Keep buying at regular intervals, buying undervalued stocks at bargain prices when the market goes down, and benefiting from profits when the market goes up. Now let's look at an example to make all this information more practical. Say you invested 10,000 in 1997 into an S&P 500 index fund at the highest point in the market. This is what would have happened to your investment. It would have increased in value as a result of the dot-com boom, then a downturn after the tech bubble popped. After this downturn, again there was an upward turn, after which we had a massive crash in 2008 following the global financial crisis. But again, the market climbed steadily for about 10 years and then took a nosedive as a result of the COVID-19 pandemic. But even with the 2020 pandemic dip, the market bounced right back up and finished on a high point by the end of the year. At the end of 2020, despite the highs and lows, your 10,000 in the S&P 500 would have been worth around 38,000. So here are my concluding remarks based on the advice and tips of Jack Bogle, the grandfather of index funds. You will no doubt want to know what he would advise you to invest in. If you are a young person, the US Total Stock Market Index Fund, which consists of 3,000 plus companies consisting of mega, medium, and small cap companies, which produce 22% over 10 years, would be a good one to go for if you are young, in your early 20s. When you start getting to your 50s, you can begin to balance your portfolio with bonds such as the US Total Mutual Bond Market Index Fund. This is Jack Bogle's strategy and tip to navigate the highs and the lows of the stock market. Whatever the market condition, these principles apply. Now, one last tip from the grandfather of index funds. Hit that subscribe button. If you found this video useful, please don't forget to subscribe, like, and share. And also comment below. That way you'll be helping support this channel, and you'll also help this video reach more people through the YouTube algorithm. Until next time, keep on growing in wisdom and maturity. Blow the cap off your capability. Be unstoppable. Be awesome. I'm cheering you on.